Welcome to Trading Nation. I'm Michelle Caruso-Cabrera, and let's do a little yield hunting. Check out some of the highest yielding names in the S&P 500. Macy's, Philip Morris, Verizon, ExxonMobil, all yielding nearly 4%, sometimes more than 5%. Are any of these names worth a buy right now? Mark Tepper is with Strategic Wealth Partners. Gina Sanchez is with Chantico Global. Mark, would you buy any of those?
Yeah. So, I mean, dividend payers, in my opinion, should be the foundation of someone's equity portfolio. Since 1927, dividend payers have outperformed non-dividend paying stocks by 1.9% a year with 39% less volatility. And that's what everyone's really looking for, right? I mean, more return, less risk. Now, that being said, we are not particularly fond of high yielders, especially in a rising interest rate environment where they tend to underperform. But we do like the dividend growers, which are those companies with the lower payout ratios that still maintain the ability to keep some earnings, to grow their future stock price and grow their dividends down the road.
How do you break the difference between a chunky dividend versus a high yielder?
So we want to identify the dividend paying stocks that have payout ratios that are lower than the payout ratios on the S&P 500. So, if we can find something that has a dividend yield above the S&P 500 with a payout ratio below, we would consider that to be a dividend grower candidate. We also want to see that they have a consistent track record of increasing that dividend at a pretty reasonable rate, high single digits, low double digits.
Got it. Yeah, the payout ratio being that how much of their profit do they actually pay out in a dividend? And sometimes things can get weird. For example, the oil companies, when oil was very low, they didn't want to cut their dividends, so they ended up paying more out in dividends than they actually had in profits. So that would be a very high payout ratio, for example. But a lot of people thought that those would eventually fall back. Gina, what would you do here?
Well, look, I think that when you look at the dividend yield, you have to remember that price is a component of that. And one of the things that tends to trick people is that price falls, dividend yields go up, especially if you can maintain a dividend payout ratio, a particular dividend payout level. And so if you look across the names that we're looking at, Macy's, Philip Morris, Verizon and Exxon, of all of those, I think ExxonMobil probably has the best chances for sustainability over the long run of that dividend. If you look at sort of the worst of those, I'd say it's Macy's. The retail sector has been really, really in a bad place, and Macy's in particular, their balance sheet doesn't look nearly as good, whereas ExxonMobil is coming out of a lull. The price now is starting to look like in the next 12 to 24 months, we should actually see oil prices starting to rise. So I would actually go with Exxon in that list.
Got it. So don't look at a Macy's and think, oh, it's paying me more, 5%, because maybe they won't always be able to pay that, is what you're saying, versus a 3.8%. It's lower, but at least you're going to get that for longer. Do I summarize that correctly, Gina?
You got it.
Okay, terrific. Thank you, guys. Ladies and gentlemen, Mark Tepper is with Strategic Wealth Partners, and Gina Sanchez is with Chantico Global.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.